I would like to thank you all again for taking the time to be here this morning. And the meeting has been honored by the attendance of the chairman of the Capital Markets Board of Turkey and also TÜYİD's senior staff. I would like to specifically thank TÜYİD for organizing such a timely event. The subject of today's panel is sustainability. Sustainability and ESG are the kind of topics which where we can achieve progress only when all the stakeholders are involved and the interests are aligned. And to this end, the composition of our panel is, I think, is perfect. And I should again thank TÜYİD for putting this diverse panel together. We have a representative from the global advisory body, S&P Market Intelligence. We have a representative from the asset management industry, and we have a representative from a very large regional and global conglomerate. So I think we have all the related parties to cover the ESG sustainability landscape here. I would like to start my, I would like to ask 2 rounds of questions to each panelist, but I think this can be a quite interactive panel, and people can freely express their opinions. First, I would like to start with Andreas. And Andreas, what are the key trends you observe in the investment space, especially from the viewpoint of an IR team? What are the key topics that should be paid attention to?
Yeah, thanks Ismail, and thanks TÜYİD for organizing such an amazing event again. Thank you for the question. And I remember 4 years ago when I was last here, we actually talked about a similar topic like ESG, etc. And preparing for the panel, I was like, in one way, nothing has changed, and in another way, everything has changed when we talk about sustainability or ESG. And for IR, for the community here, I think you are at the forefront, we are all at the forefront when it comes to ESG, because the capital market has been one of the most active and significant drivers of sustainability and ESG, and I would say that's the reason why we're talking about it so much now. What are the key trends, or like also from a global and international perspective? They will probably not be, or you will recognize them if you're active in the market. Number one, I think never before have we seen so much regulation that is linked to E, S, or G related topics and factors. Everybody talks about climate right now, and there is 1,700, for example, climate-related regulations that will have some sort of impact also for you right now. So regulation has been very, very dynamic, actually, after the capital market participants, especially some institutional investors, have driven this for quite a long time already. I think then that's this regulation number one. Second, the way investors think, and I'm really looking forward to the discussion, and the way ESG is integrated in the decision making from an investor perspective is changing. And I think that's what we all feel, and that's what probably most important for the investor relations community, because what we hear a lot of times, it's still a black box on how, we're all asked for all of that information, for the disclosure, for the data, all of these things. But from an IR perspective, it's not clear on how investors really integrate ESG. But that has actually changed quite a bit over the last couple of years, because it has been very granular. It can be quite granular from a fund manager, from portfolio manager, from asset management house to asset management house. So the way ESG integration now works, I think, is very different than it was a couple of years ago. While, some investors really believe in ESG and the extra financial impact, so that you actually can generate alpha, that you can make money with ESG, and some others kind of have live up to it because regulation pushes it onto them. So the way corporates are facing and experiencing the burden on ESG, I think it's the same way for the investor side as well, especially if you're somewhere linked in the European Union. It's incredible of what investors actually have to do to live up to ESG as well. So they face similar issues. So regulation, ESG integration, and the sensitivity of your counterparts has completely changed over the last couple of years. So very granular. And there is two more, in my opinion. There is a continuous shift to passive investment. I think right now, in the current market environment in Turkey, that's especially important because obviously the macro environment right now is not ideal here, globally, but especially here. And hence you see a flow into passive funds, which are also integrating ESG, but there is not a lot of IR activity that actually can, it's a bit more difficult for you to understand on how they actually do it. And the way they do it, and why this is important, is because there has been this emergence, and that would be my fourth and last point, this emergence of this ESG ecosystem. ESG ratings, ESG scores, ESG data that you're asked for, right? It's a business now, including us, S&P Global, right? We are also in it, and many, many others as well. Like, you're asked for so much information, and this information is used by a lot of market participants, including the passive investment community, and the active ones, but especially the BlackRocks and Vanguards of this world rely on information that is being produced by yourself or that they collect. So these are 4 trends, and I think they will continue, and they're actually both a risk and an opportunity for you and for the investor relations community, because you cannot ignore them. And if you're on the forefront, I think the sustainability topic is actually a huge advantage for IR. So it should be exciting because you can differentiate. If not, then you're more in the passenger seat, and you probably will continue to, like all of us, I guess, feel the pressure and the burden there. So maybe I'll close there as the first round, but I think these are the 4 kind of main directions that we also see.
Thank you, Andreas. Ebru, may I continue with you? The ESG and especially climate-related issues are becoming an integral part of business. It's becoming a business risk and maybe a business opportunity as well. How do you at Koç Holding, as we know, Koç Holding is a very large conglomerate with operations not only in Turkey but also in many countries, especially in emerging markets where ESG and sustainability may be a bit of a challenge. How do you manage these risks? How do you set your targets?
Thank you very much. It's great to be part of this conference and panel as well. As Andreas mentioned, in the last couple of years, we are working very closely with IR team, finance teams, and sustainable teams, and I think this panel is a testament of it. So, as Koç Holding, especially related to climate issues, how do we see our performance? I mean, there are some factors that we see our performance in. Number 1 is the commitments that we give, the targets that we give. This is the number 1 thing. Of course, target setting is not the only thing. Having a clear transition path towards that target is also very critical, because in climate issues, targets are very long-term based, so investors and our other stakeholders want to see our path towards those long-term targets. As Koç Holding, we announced our carbon neutrality target by 2050 in this year's annual report. We also have a pathway, namely by 2030 we will have 27% reduction, and by 2040 we will have 49% reduction. Again, while giving these targets, of course, we also need to have some initiatives and projects in place to reach these targets. And also linked to that, we have to see our risks and opportunities as well, as you mentioned. While analyzing our risks and opportunities, we adhere to the TCFD framework. So as Koç Holding, we are a supporter of TCFD. This gives us a great framework, and currently it is, I can say, the best practice globally, because through TCFD analysis we can both analyze and report on our transition risks and physical risks. Under transition risks, we look at our policy risk, reputation risk, technology risk, market risk. Under physical risks, the climate-related physical risk. Of course, this is not only from a risk perspective, but also an opportunity perspective. Once we analyze the risks, then we can come up with the initiatives and opportunities. Another important international platform for us is linked to our physical risks, which is water is the number one issue currently for us. For our company. We are signatory of UN CEO Water Mandate. This is also a very important international platform at the water area. So we work together with them and share best practices and improve our performance in the water area. The third thing I want to mention, we are a partner of World Economic Forum as another international platform. We are also a supporter of World Economic Forum's stakeholder capitalism metrics. Because Andreas also mentioned there are many different indicators in the area now. This stakeholder capitalism metrics is combining all different types of indicators under one platform, so it is important for us to adhere to them. So number one is setting targets and having clear transition pathways. Number two is supporting international platforms and improving our performance accordingly. Thirdly, I want to mention sustainability indices. They help us to show where we are in terms of performance in ESG and how we can improve that performance. Currently, we are in a BIST Sustainability Index. We are in Sustainalytics, MSCI, FTSE4Good, and VE Moody's Sustainability Index. These are important because in order to increase our performance in those sustainability indices, we need to work with different functions within our company, also in the group companies, and we make sure that we adhere to the standards that are asked from us by those indices. Let me stop here, and I can talk about maybe more about the governance of our performance in the second round.
And Anastasia, you are a fund manager based in London, and you're actually an emerging markets fund manager. So emerging markets can be more challenging environments for ESG and sustainability. How do you integrate ESG into your decision-making process?
Thank you for your question. It's a tricky one. I have to say that as the companies, we as portfolio managers, we are kind of in between the clients who are pension funds, investment funds, or individuals, and regulation, government regulation. The same way as the company's main priority, and it will always be in the articles of association, is profitability. The same way for investment manager, the first criteria that we are judged on is return. So the first fundamental questions we are facing is that how much our clients are willing to sacrifice returns for the sake of ESG or getting higher ESG standards. On that one, I would say it's much easier now to invest in Europe or developed markets than emerging markets. And the reason why is that a lot of the growth in emerging markets is driven by consumption. And we like it or not, it poses the main question. Are we, as consumers, and the governments, as our representatives, are willing to sacrifice some of our consumption for the sake of ESG? Are we willing it to do on per capita basis, personally, a little bit more, or as a whole? So for us as a portfolio manager, of course, we follow sustainability accounts, boards, standards, the UN themes of the investing. But in the end, we need to ask ourselves, if we invest in the company, they tick all of the boxes, but fundamentally what the climate or social changes or economic challenges they face are in 2 or 3 years in the long term. In the case of Turkey, your main question, I think, is your main trade partner is European Union. European Union ESG regulation went very far. The Germany standards, some of the European Union green standards. That affects your some of your end consumers. That affects some of your investments into Europe. So fundamentally, the question is, are we willing to sacrifice part of the growth for the sake of ESG? I think the answer at the moment is that in Europe, yes. The question is, it will be very interesting next 12 to 18 months, to what extent higher energy prices, higher fertilizer prices, high inflation driven because of some of the ESG policies will be tolerated by the end consumer. For Turkey, it poses the question how Turkey is facing the dilemma of its main trading partner being going through the very serious economic challenge. And is Turkey willing to, to reorient it towards some other partners in emerging markets where the standards are not so high?
And this year has particularly been a difficult year given the war in Ukraine. ESG-friendly investments have probably not performed as much as they should have otherwise.
I would say that we as fund managers, we weigh two things: the company and the stock price. These are two absolute, and you all know that these are two absolute big differences. The company can be a fantastic company, but the stock or not so good, but the stock price can be pushed by additional factors. One of them, Andreas mentioned very nicely. There is a lot of pension funds. The ESG as regulation is rolled over the world, and resulting in the fact that there is a lot of passive money pushing into ESG fund. Is it greenwashing, or is it just a temporary trend for 2-3 years? We will see. But the fundamental question is, for example, there was a very good example on the recent Apple earnings call. Apple margin, I'm sure we have some of the Apple consumers here, before the phones were sold with the chargers together. Charger came in the one pack. They've changed it several years ago. Now they sell you a phone and they want you to buy separately a charger for $25 or $26, depending on the market. It's fantastic business. The margin, the profitability margin they're making just on separately selling the charger is 3 times they're charging on the phone. The problem is that the packaging and transportation cost for the separate charge is much higher. Marine heavy fuel that they're using to transport these charges from China are several times higher. So on the profitability level, the company is doing fantastic. On ESG level, on facing some of the tough questions, it's difficult to judge. So that's the balance. Same with the electric cars. It's all very fine idea, or solar energy or wind power that you are making. You're doing fantastically in Turkey. It's okay, at this point of time, but the time of decomposing of the fiber optics panels of the wind farms is they're not recycled. The decomposition time is over 300, 400 years. Solar panels, same. So lithium batteries, look at Chile. So for us as investors, we have kind of a formal approach that we need to comply with all of this. But then we need to look at the big picture. And fundamentally, I don't think yet the governments or the regulation body are willing to ask difficult questions. What is the cost and what is the amount of the costs that the companies and consumers are willing to pay for these better standards? So that's...
Okay, thank you very much.
I think maybe just because it fits so nicely, I think what I actually forgot to mention is, because you're basically saying, what are you willing to give up as a return if I then have a proper ESG strategy, etc. And what I find interesting is that when you actually ask the consumers, one trend I forgot is that there is a generational change when it comes to wealth management. So when you ask, and there's a couple of studies out there, younger people, or people that now start to invest money, right? Younger people, the millennials, women, high net worth individuals, for example. When you ask them, all of them place a very, very high importance on longer-term sustainability factors. And that's why also the investment products are changing, because you're catering to that demand. And where we then end up again with greenwashing, because when you look behind the label, sometimes this is accurate, sometimes it's completely bullshit, right, behind what actually it says on the fund. And that's where regulation comes in, and I think that's where especially the EU, you said very far. They went very, very far, where you can argue, does this kind of stifle actually, in the investment landscape to some degree? But I think what people sometimes forget is, so there is a larger trend when it comes to actually investing happening, where actually people, and there's a recent study, I think by the London School of, by Stanford it was, they asked thousands of people, and they said they're actually willing to give up to 10%. They would be willing to give up to 10% when you can ensure that longer-term performance on an ESG level is actually in line with their expectation. So what I think we sometimes forget is that ESG is always talked about this thing. It's like it means something, but it means nothing. It's proper management of the business. I think it's a lot of risk. Like, how do you manage your risks? And that should happen anyway from a company perspective now, and you might have now climate, etc. as well, and a few others. But what sometimes people think is like it's just a lens through which you run your businesses. Executive level, board level, IR, all of a sudden you have to deal with these issues which can be cumbersome. But the other part that I think is important to say, it's a long-term, ESG is a long-term play. It's a redirection of capital from the regulator that is not going to happen next year, but longer term to maybe solve some of the larger issues as well. And the question will be, can you actually make money with this? And like to make sure that what you mentioned, this also applies or not. And if you from the corporate side, from the IR side know this and understand the dynamic, I think it can be an interesting opportunity also in the short term and in the long term, because if you can cater for that market dynamic. I don't know if that made sense, but that there is a larger dynamic also going on.
Thank you, Andreas. Actually, I would like to continue again with you in the second round. What are the best practices and focus areas you see for issuers of both equity and debt in the capital markets?
So a big focus right now is on reporting and disclosing and transparency when it comes to ESG. Why? So that you can start to compare and measure and standardize in one way or another. I think you mentioned this before. Best practice, or what also the market is looking for, is you as a company and investor relations have an idea of what does the climate risk and other risks actually mean to your company, and give a forward-looking view. You know, that's why some of these targets are very important, because it's not backward-looking reporting, but do you have an understanding of what the real risks are? Do you have an idea on how you at least try to manage them? And what does that mean for your business forward-looking? If you manage that, I think that's the single biggest opportunity, actually, best practice, to get that type of understanding. And that is actually not easy to do, because it requires a lot of resources to actually get to that point so that you can make that claim and that assumption. And then I think the second part, and you also referred to this already, is how do you then manage that process, so that governance aspect of things, which is more of a risk reduction, and then also will probably potentially lead to a return in the long term. So I think understanding the material drivers in your company and then be able to compare it with your industry, because ESG is data-driven and it's always, or most of the time, on an industry level. So you have to be compared to your peers. You can't compare bank with an oil company, etc. It's very, it doesn't make sense from an ESG perspective as much. So that transparency, good data, because with good data that you disclose, you steer the market and you impact the entire ESG ecosystem. All the ratings and scores will immediately be impacted if you provide good data to the market. And then if you can run it from a strategic mindset, from a strategic level, and guide the market on how you are trying to achieve, let's say, your goals, I think you have a very good position in the market to tap into the passive money and a lot of the active managed funds that take care of ESG. On the bond side, it's the same thing. Don't fool the market, because there's been a lot of greenwashing on green bonds or ESG sustainability-linked bonds, and actually just now, a lot of the fund managers look behind the label and start to engage. So I think it's a little bit easier there.
Thank you, Andreas. And Ebru, back to you. In order to be able to successful in sustainability and ESG issues, they need to be integrated into a company's or a conglomerate's business strategy. And this is also important for avoiding greenwashing. By greenwashing, I mean just using it as an advertising tool rather than actually doing something to improve your ESG levels or standards. How do you at Koç Holding do this? How do you achieve this goal?
Thank you. I also, before answering directly to this question, I want to underline the importance of transparency. We are witnessing that as well with our engagement with stakeholders, especially investors. We do not have currently all the answers, of course, because as I mentioned, we have long-term goals, and many of the technologies are not even here. We don't have those technologies, so there are unknowns. However, what stakeholders want to hear from us is really being transparent about where we want to go, about our risk challenges and our plans, what we know and what we don't know, but what kind of plan we have. That's what they want to hear from us. We get this feedback whenever we engage with our stakeholders. So I think it's very important, the transparency and the engagement with the stakeholders. In terms of how we are managing, at Koç Holding, we have several, quite a few actually, programs that are part of our cultural transformation. That's how we position them. Carbon transition program is one of them. It's how we manage our climate-related issues and target. Under carbon transition program, at the core, we are 3 teams working together very closely: sustainability, finance, and strategy. As I mentioned, finance is at the core of the program. And greenwashing, I'm glad that you mentioned it. We take it very seriously, because there are currently, actually, there are some key criteria, but no standards, or there is not a regulation currently that we all need to abide by. That's why, before even there is a regulation, voluntarily we take a greenwashing issue very seriously. And how do we manage it? Number one is being very clear about the definitions, about the boundaries. When we are talking about targets, both Koç Holding and all group companies use the same definitions. And whenever possible, we use science-based definitions. Of course, you mentioned we are in different sectors. We are in energy, consumables, automotive, finance, food, and other sectors. These sectors are different dynamics when it comes to climate, and they have different standards as well. So we make sure that our group companies are in line with the terminology, the definitions related to climate in their sectors when they are announcing their targets. Also, a second important issue is the governance, because these targets are very binding targets, and we need to have investments behind those targets in order to reach them. We make sure that the targets are approved at the highest level, at the board level, that there is board oversight around our targets and the transition pathways to reach those targets. These are the key things that we give importance to. As a third point, in terms of how we are governing the program, we have, of course, very wide networks within group companies that we are working with. It's not only finance, strategy, and sustainability teams, of course. It is purchasing teams, it's marketing teams, it's environment teams, production teams. So very different teams working very closely. And also at group-wide, we have different councils: Environment Council, Energy Council, different councils. This is more the bottom-up approach. And also from the top down, I should say that the whole program is under the mandate of the CEO. And as the managing team, we are also regularly reporting to the risk committee under the board. So there is board oversight as well. This is in a snapshot. Thank you.
Thank you very much. And back to you, Anastasia. Actually, I'll kind of follow up on the last points you made about EV cars, electric vehicles, etc. How do you decide whether an investment, whether a security, or whether an issue is ESG compliant or not, or whether it passes your criteria? And also, could you a bit elaborate more on how do you see the electric vehicles, renewable energy, etc.? Are they really doing good for the environment in the long run or not?
You're putting me on a hard
And maybe-
spot. After 2 weeks, Turkey unveiled TOG.
One last point, I just want to maybe support your thesis. I read an article, actually a comment by Toyota's CEO a couple of days ago, and he was saying that they are not yet fully committed to electric vehicles. They are evaluating the consequences.
Yeah, I mean, as I mentioned, so there is formal, obviously, it will be fair to say that every normal planet in the world would like to live in the cleaner, more sustainable, fair, and equal place. So it's a normal desire. The question is, for us as investors, you know, can we deliver the returns? Ticking all of these boxes. So I think that from the, going back to the previous commentators, I think the social and governance aspect of the ESG is much easier to tackle within the company because that's a human capital, equal pay, equal representation, maybe mentoring programs, maybe benefiting some of the less fortunate classes of the society for the employment. That's all composing the board, governance code. So that's within the company's reach to fix relatively quickly. Let's say, you know, we would expect the company to comply with all of the social and governance targets within 2 years, and then show the dynamic to improve it from there. The more climate or ecology or energy trends, it's much more difficult because we are at mercy of the global economic trends and government regulation and government policies. For example, going to your point about electric cars or sustainable electricity, Germany has very aggressive targets, and also UK to be carbon neutral by 2030 and pretty much to have majority of the electric cars fleet by 2030. The person in UK who brought it up was Lord Skidmore, and I had the luck to talk to him about this, and it was clear that UK will not meet the target. But the answer that was given, it's a moving goalpost. So I think that first the businesses need to understand that they really need to watch closely to what government is doing and not to kind of run ahead of the steam train. Because in Germany, for example, the major pan-Germany transmission electric lines are not ready, and they will not be ready by 2027, even if some of the large businesses will move to the more sustainable energy sources. Again, in Europe, we are seeing significant shift and living of the businesses because of increasing of the electricity cost from the main power. BASF, one of the major chemical concerns, is operating 60% of its capacity. More than 30% of the glass manufacturers are idle because of the higher electricity cost, partially driven by the more renewable, sustainable sources. And we can continue this list. So my point is that the cost will go up. Turkey is a very pragmatic country. Turkish businesses operated in the last 30 years in an extremely tough environment of the high inflation, high competition, relatively volatile political sphere. I'm sure they will find a way to navigate these challenges, but we need to ask, you know, fundamental question: is the consumer willing to bear the costs? On the electric vehicles, there was 2 companies in Europe, one in US, that just went bust in the last 2 months because they were not able to deliver the product at the price they promised the consumer. I really, really love the Turkish initiative on TOG. I think it's a fantastic example of cooperation of more than 4 companies, but it won't be easy. It won't be easy.
Thank you very much. I think we have about 10 minutes left. We can open the floor for questions and receive some questions from the audience if anybody wants to ask any questions to our panelists. Please.
I'll start over. Hi. Do you think that companies should actually standardize their ESG strategy to make it more comparable on, a global plane? Or, for the better of the good, should the companies really invest into their own strategy on their side of ESG where they can actually make changes? What's your point there?
I'm happy to start. So that's probably my personal and the company answer to your question. I think the companies are well advised to come up with their own strategy, because that can be the big differentiator, namely, again, from an investment perspective. If you have figured something out and we all are challenged by what is going on, completely agree. And companies, some go bust and some will figure it out, but I think you will be well advised to actually really figure it out internally and then guide the market. What I do believe should be there to better compare is a minimum set of data definition, a framework, a minimum, not what's currently trying to achieve to standardize all ESG frameworks, because actually the market does not want that. But a minimum set of comparable information that allows better decision making from the outside. But otherwise, I think it's a lot more powerful and impactful if you drive your sustainability strategy outside of your company. And there was a great study by George Serafim that actually discusses exactly that from 2 years ago, where you can actually then link it to market performance, stock market performance on companies that come up with their own strategy, goals, etc., versus the ones that copy it or that are very similar to their peers. It's pretty interesting to read. Maybe.
From the investor standpoint, I think that the main systems we are using is predominantly Bloomberg. The sustainability accounts guidelines, they do have industry-specific sets of criteria, and it will be reasonable to look at that. We do look at those. I would say that, unfortunately, the Bloomberg reporting system is still very, very far from ideal. It's a lot of rubbish and a lot of just empty spaces, to be honest. So we can't rely on that, which means that we have to do a lot of the own research and data digging. It will be much more easier for us if the company would be able to provide this within, let's say, regular disclosure. It doesn't need to be quarterly. It can be, part of semi-annual or even annual report, just the set of data. But the same way as general accounting principles came, to fruition after 20, 30 years to try to standardize the accounting principle, I'm 100% sure that in 10 years we will have some kind of a sustainability standards that you will have report. But at the moment, we first and foremost will filter companies on their fundamental balance sheet strengths and business model strengths. So let's say out of 5,000, 6,000 companies, we will filter down to 300, and then we will put an ESG filter on that. So fundamentally, it will be very hard for me to justify to invest in the company with the falling business, even if it has the best ESG standards out there. So it is a luxury, as it's kind of necessary luxury, a cherry at the top of the cake, but the strength of business is number one factor first and foremost.
My question to Anastasia, when you set the scene, you said this still will depend on how the consumer, to what extent they accept to consume less, and to investor to agree the less return, and the companies will agree on less profit.
Yep.
Why we are setting the scene that kind of a negativity? Is there is no other way to reach the most valuable thing, which is the saving the planet? I know that's the uncomparable. Is there any other way?
It's a 10 million question. I wish I had an answer. But unfortunately, last 40 years of growth, it was predominantly based on consumption. It was based on the corporations and large companies cutting costs by moving businesses into cheaper labor countries, and the countries with the initial sources of cheap resources, be it water or be it coal, and so on and so forth. So, interestingly enough, we are starting to see this trend pretty much halted. Partially because the wages grew in all of the largest India, Chinese businesses are now moving to Vietnam and Cambodia. We all know that. So that trend stopped. But fundamental question under all of this is that there is 8 million people, if I'm not mistaken, we hit that target last week. They all want to have fridges and they all want to have washing machines and so on. And these are produced on the other side of the world, or they want strawberries in the middle of January, like we have, in most of the Europe. All of this is transported by very heavy polluting marine tankers, container ships, bulk carriers, and so on and so forth. So the question in Europe, everyone has already washing machine and toaster, but in emerging market they don't. So what do? Do we ask Europeans kind of to pay more and do not improve their life standards, and we are still allowing the emerging market consumers to grow and continue consuming, or we are telling these guys, no, it will be double price for you now. So I don't have the answer for this question, but it is clear for me that if we are putting higher ESG standards, not all of the countries will accept us. Even US hasn't accepted most of the ESG targets by COP. China hasn't accepted. And between China and India, we have 40% of the global consumers, if I remember correctly. So the question is, are we going to face slower growth in the coming 10 years at partially the cost of the higher ESG standards?
Andreas, would you like to contribute?
Oh, I think that's exactly the discussion, right? And the problem in a way, because there's the ideology. We all want to save the planet. I mean, I guess we all want to save the planet if we could. But that means that things cannot go on like they've gone on for the last couple of years. I mean, we just came out of COP27 and the whole concept of loss and damage. So the more developed world kind of helping, maybe the developing world for what they've cost through the way we lived over the last couple of decades. It's a difficult one. And then you have we want to earn money when we invest our for our pension, etc. Maybe the system doesn't work anymore as it is, but I think when you break it down to the end consumer, to us, to my parents, etc., they still want to go on holiday, right, and do the shipping trip, etc., and it's very difficult for them to not do it, because actually what we are discussing here, it all starts with us as individuals, in my opinion. But the reality is that the system that we're in needs either change or we have a larger issue, I guess. But that's the ideological side. My question would be, all being equal, can you still make money by can we all still make money by placing the decisions on investing in a more sustainable company versus their peer that is not sustainable, right? Or not as sustainable? A Turkish company in finance versus another one that is not as well advanced, also in another one maybe from another country. My argument would be, yeah, you can actually still make a lot of money by also looking at ESG as a risk and opportunity factor. But I think that's something that we will find out over the next couple of years, because also a lot of information was not available. It's still not available, like you said. The last part I want to make is consumption and who's actually consuming and the real prices that actually are being charged. What we should not forget, and I think what companies in Turkey should not forget, is the whole topic around supply chain. There is this huge supply chain focus now, and a lot of the products that are being produced here, you're selling into Europe and other parts of the world, and that if you don't live up to a certain ESG standard, everyone, and also here, you might lose your buyer in the next couple of years, because the BMWs of this world will no longer be allowed to get your products, for example, if you don't have a certain ESG standard as part of their supply chain. So I think that is probably actually the single biggest topic over the next couple of years, going into the private markets as well, that if you're part of a larger supply chain, you need to be aware about what the minimum standards are. And
I agree with Andreas. There's a lot of, you know, to be honest, it's like we're very early in the beginning of this process of ESG, and there is a lot of shifting grounds, shifting sands. So I only would say just don't, you know, from the IR standpoint and from the head of strategy or strategy director of the company, don't take it as the kind of set of principles. And the reason why is that, for example, in Germany, Chancellor Scholz was in China a couple of weeks ago with the representatives and heads of all of the main European car manufacturers, as well as fertilizer producers and chemical producers. One of the things that they were discussing pretty much shifting the production to Asia. Why? Because Europe is in significant economic headwinds and trouble. European consumer will become poorer. We like it or not, the core of the global growth and markets and consumption will be in Asia. So the people who set these principles, German government themselves are looking that way. So just kind of have an open mind, look at the big picture, and as the business, you know, Turkish businesses are so resilient. That's why I love investing in Turkey. I mean, you can survive anything pretty much, you know. Just, you know, use the opportunities smartly. We all want to have higher standards, but maybe the price is somewhere else.
Please.
From a bigger picture, you mentioned COP27. I was at COP27 last week. There was an emphasis there. We are talking about should we stop growing or what's the options, this dilemma between developing countries and developed countries. There is one thing we need to keep in mind, that was mentioned a lot. We are talking about 1.5 degrees target if we are going to make by the end of this century. 1.5 degrees target, company targets, country targets, discussions. But it's not a target actually, it's a limit. So 1.5 is a limit. If we go over that limit, we will not be able to live our lives as is. Our businesses will not survive as they are. So actually this transformation, the businesses that can transform themselves will survive and grow. There is no other option.
Thank you very much. I think our time is up. Thank you very much, Ebru Hanım. Thank you very much, Andreas. Thank you very much, Anastasia. And thank you all.